Welcome to Kitco News. I'm Niels Christensen. The gold market remains resilient. Prices have regained most of their losses after the recent 8-week low, but are they ready to take off? Here to talk about his thoughts on the gold market is Adam Button, Chief Currency Strategist at Forexlive.com. Adam, thank you very much for joining us today and talking about gold.
We're glad to be here, Niels.
So let's just jump right into this. What are your thoughts on the price action we've seen in gold? Is this something, or is it just regular churn in a market that's looking for a new catalyst?
Yeah, I mean, at the moment, you have this sort of push and pull in gold, right? The picture for gold in the long term is better every day. Massive government spending, ultra low interest rates. But the demand for safety is plunging as the market gets extremely enthusiastic about the reopening. And so we're seeing some money come out, short-term money coming out of gold. So I think you have these long-term strong hands that are building up positions in gold, but some of the weaker hands are getting shaken out. And that's sort of the ebb and flow that we've been stuck in the past few weeks.
So in this environment, in this tug of war, how would you play gold? I mean, are you buying? Did you buy the 8-week dip? Are you looking for sort of better prices to buy, or are you waiting for the breakout to buy?
Yeah, I think that's the trade right now. The last one is waiting for that breakout to buy. The enthusiasm right now in the stock market is bordering on a mania. It's an absolute party going on, and everything is getting bought, and that's kind of left gold, sparkling a little bit less brightly. And so I fear that we might see another downdraft before we move higher. On the other hand, I'm a massive bull. I think that this is going to be the decade of the gold trade, and you don't want to miss that. I mean, I think it's okay to miss the rally from these levels up to 1760. But I think you absolutely have to buy 1760. And then within that, I think you're seeing a lot of retail money flow into miners right now. And you see that, you kind of have these ETF trades that are very top heavy in gold miners. And you're starting to see more discretion. And I think that's interesting to me, and it shows that retail is coming into gold, but a little more selectively than we saw maybe a month ago.
So what do you think gets us above 1760? I wanted to ask because, looking at the U.S. dollar, we've seen a 4-week downtrend in the U.S. dollar hasn't really provided that much momentum for gold. So I'm sort of wondering, I mean, what do you think is needed to get to the breakout? Is it lower equities? Do we need to see this mania turn into panic?
Yeah, what's very interesting about the last 2 days is we had certainly a mania to start the week in stocks and last week, and then we see a pullback here on Tuesday, and the dollar has struggled in both environments. And to me, there's this growing sign of a dollar bear market, which is fantastic for gold. And so that there is a few charts to watch, like dollar against the Swiss franc, which is breaking down right now. Traditionally, that trade is a kind of risk-on trade. The dollar would generally rise against something like the Swiss franc or the Japanese yen in a positive environment, and it's not right now. So you can see why. I mean, the U.S. has massive deficits. These protests are going to spur more spending, and the Fed, in all likelihood, is going to keep and signal that rates will stay low. So there is a great reason to sell the U.S. dollar, and I think once American investors maybe get attached to that idea, or that dollar weakness trade gets to be a bit more of a mainstream kind of trade, then we might see that real big leg up in gold. The timing is obviously the question here.
So last time we talked, you said, we're in this new normal of monetary policy. Obviously, we're expecting the Fed to announce monetary policies this week. What are your thoughts? Does the Fed still have ammunition? Are you looking not just to signal lower rates, but some yield control, especially as we see 10 years sort of bounce higher lately?
So the fear right now from the Fed, if you're a gold bull, is that the Fed comes out and takes away the punch bowl, the classic end the party before everyone gets too excited. Yet, just on Monday to start the week, we saw the Fed easing the terms of their new Main Street lending program that's going to be rolled out probably this week. So, I don't see anyone at the Fed coming out and saying, listen, we've goosed this market too much. We're adding way too much liquidity and we want to reel it back in. When we came out with all these programs, it was about market functioning. And the market seems to be functioning just fine right now, but they're not sending any kind of signal about reeling that back in. We've seen that over and over in the last number of years from the Fed. Those jitters are there again right now. And I think ultimately the Fed comes out and says, listen, we're going to wait and see. We're ready to do more, but we want to see how this develops. That's reasonable at this point. And I think that kind of signal is good for gold, bad for the dollar, good for equities. And we get back to where we are. And that could be the thing that takes us up above 1760. That said, we've had a number of catalysts in the last few weeks, and it hasn't been able to really get that momentum moving. So it's a bit of a wait and see story at the moment, especially with the madness in equity.
This has been fantastic conversation. So upside 1760. Where do you see it on the downside? Where do you get worried that this long-term trend is at risk? Some of the numbers I've heard is it could fall as low as 1520, and we're still in this bull market. What makes you sweat?
Yeah, if we were to see a 15 handle on gold, I'd be shocked. I don't expect to see that for a long time. We may get close. I got a little bit nervous last week when we saw 1680. Obviously this pandemic isn't proving to be as bad as we feared in March. I mean, people were scared to get their mail in March. And now this reopening trade is on, and it's real. Hospitalizations are falling. But we don't know. We don't know any more really than we knew 3 months ago about this virus, how it will spread. So there's a tremendous amount of uncertainty there. But the general theme right now is that it's not as bad as feared. I mean, hospitalizations are falling. And if we were to kind of get back to normal, though, I think that's ultimately what takes gold higher. So at first you might have the safety trade comes out, and that's totally understandable. But then when we get back to growth, I think you still have ultra high deficits and ultra low rates. And that's not going to change, especially the fiscal deficits. This is the era of debt monetization. And as we saw coming out of the financial crisis, gold didn't make the new highs in 2009. It was after, as the money and that liquidity stayed out and available, and the risk trade started to turn around. So that's all happening in gold, and I think the patient buyers just need to find the right amount of gold to hold and be able to weather a dip down to 1600. At worst, I think that's the downside. If we get below that, something will have had to change.
Thank you, Adam, for your thoughts. This has been a fantastic conversation.
Always a pleasure, Niels.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.